So I want to get into today chapter 3 of the book. And we'll probably get through the whole chapter. It's a shorter chapter. It has some complexities to it, but you have tomorrow, Saturday, Sunday, to really familiarize yourself with the first 3 chapters of the book. So if you feel like you need more practice, there are other practice models on the website. But I would think my recommendation not to focus on those yet is maybe to, if you feel like you need more practice, just delete and try to rework the model that we've been doing together. I think is the best practice you can do for now, and maybe catch up on the reading. If you haven't done the reading, it does give a little bit more detail than the way I explain things. So you might find it to be interesting or more helpful. And if you notice, each chapter is broken up to 3 parts. There's the conceptual, there's hard coding things, and there's projecting things. So you might think, so you don't feel like you have to read it cover to cover, but if you know how to navigate it, you can think about, oh, I need more information on this piece, then that would be helpful. Depreciation has a little bit more concepts that we need to talk about, starting with what it is and what it's for. So what is it? What is depreciation?
Depreciation is whatever you have tangible asset.
Tangible asset?
Yes, you spread the cost with time period, life period, and then you kind of you take what you pay during the time period.
You take what you pay for the time period. Yeah, I see what you're trying to say, and that's right. But for what purpose?
Matching principle.
Yeah, I mean, there's a lot of accounting matching principles that are components of this. Yeah, revenue matching principles in what way? Yeah, expense of what? Wear and tear of the assets. Exactly. So it's the accounting and all the nuances that go with that, the matching, but it's the accounting for the wear and tear of your assets. So you have property, you buy. Let's go back to this truck delivery company. You buy a $20,000 truck, and when you buy the truck, it goes on your balance sheet. So you buy a truck, and let's say we have a balance sheet. Let's say we have a balance sheet that has, it's a startup company, we have $20,000 in cash, and we have $20,000 in equity, okay? So somebody has put $20,000 into the business, right? So what do we do with this $20,000? We buy a truck. Okay, we buy a truck, and so just for the balance sheet perspective, our PP&E is going to become $20,000, and the cash is going to go away, right? We used the cash to buy the truck, right? There's a cash flow. Okay, if you really want to. The cash flow impact would be purchase of truck, $20,000, right? And then cash will be $20,000. I'm going workers. So the cash goes down by 20, and the PP&E goes up by 20,000, and so cash becomes 0. Right? This is what I'm trying to say. This is what you end up with, right? You end up with a truck and equity. Now, the idea about depreciation is, getting to revenue matching, is the value of that truck is going to decline over time. So how do we account for that? So let's say 5 years later, the value of that truck went from $20,000 to $10,000. That cut in half. From an accounting perspective, how does that happen? What's the balancing account? You lost $10,000 in value, but why?
Non-cash loss.
Okay, it's a non-cash loss, yes, which would be considered like a write-down.
Yeah. You
could write it down. You could do a write-down, but in today's accounting, you can do something better than that, right? You can expense it. You can expense it periodically. That's depreciation, right? The idea is that the argument is, well, the value of my truck decreased because I was using it to make my operations. I was driving it around and hitting potholes and doing all these things. That was reducing the value of the truck. So accounting rules said, okay, well, you can maybe find the periodic degradation of that truck and expense it over time, and expensing it has the benefit of what?
No tax.
Tax deductions. This is the depreciation accounting, right? So we can say, okay, well, that $10,000 becomes an expense, and so what's the balancing? It's not a write-down then. What's the balancing impact to this?
It's a loss.
Under what?
Retained earnings.
Retained earnings. It becomes retained earnings. Retained earnings, this is the culmination of the expenses. That's the idea. That's what balances it. So now we have assets is 10,000, and then the sum of the equity is 10,000. Right? But this won't happen. This won't be a one-time kind of thing. This will be periodic. Every year, a little bit goes away, a little bit goes away. And then there's also the impact of taxes that we didn't talk about here. So there's a little bit of a switch because of the impact of tax. But this is the general idea. It's why are we, and so this also, thinking about it this way, also helps answer a lot of questions of why is depreciation expense non-cash? Because if you think about it this way, it's kind of theoretical, right? We're just finding some way to say, okay, well, we have this expense, and the expense is the idea of accounting for wearing away the asset, but we're not really actually writing a check for $10,000 to anybody. It's just the theory for why the value of this truck is degrading over time. It's a non-cash expense. Okay, so let's say, I'm going to go back and rewind to this from this $20,000, okay? Let's say we want to justify a depreciation rule for this truck, not just $10,000. There are ways to depreciate assets. And the two major categories is straight line and accelerated, right? Straight line and accelerated. Straight line basically evenly spreads out the reduction in value over time based on the life of the asset. So for example, if you buy the truck and somebody says, okay, the truck has a value, a useful life, and an appraiser would tell you this, has a useful life of, let's say, 10 years, then you would just divide the value by 10. If you divide 2,000 by 10, okay, then the value would be reduced by $2,000 each year, and by year 10, the value would be zero. That's straight line depreciation. Okay, the value of the truck, reduction in depreciation, spread out evenly over the life of the asset. So, and let me do this on the OneNote so I can record it. So let's say, for example, we have this truck. Now I'm going to pull up the balance sheet. And right now the truck, what we have in our final balance sheet is we have no cash. We have PP&E here of 20,000. And we have equity, let's say, a stock equity investment. Somebody put in an investment of 20,000. This is our balance sheet, right? Now let's say, okay, we've identified, or it's been identified when we purchased this truck, that it has a useful life of 10 years. And we've decided to account for that on a straight line basis. So 20,000 divided by 10 means every year we would depreciate this by 2,000. What would be the income statement, cash flow statement, and balance sheet impact on 1 year's depreciation? Okay? Take a second and think about that. Okay, you might not get it right, but think about it, give it a shot. What would happen given the tax impact on the income statement, cash flow statement, and balance sheet? Okay, I want to just pause this so give you time. Okay, let's go through it. What do you guys think? Got an income statement impact, depreciation, right? 2,000. So this is a common question. If depreciation expense is 2,000, what happens to the income statement, cash statement, balance sheet? So it's good that you kind of go through this. So continue.
EBIT's going to decrease because of it?
Yeah, EBIT's negative 2,000. Yep.
You take a tax rate of 40%.
Okay, so what's the tax on that?
800.
Mm-hmm. And then the net income is 1,200. Mm-hmm. Okay. Okay. Now what? Anybody? Or doesn't have to. I'm not trying to put you on the spot. Drew, could be anybody. Well,
Tax shouldn't be, when we have depreciation cost, the amount of the tax you're supposed to pay, it shouldn't be less than the normal.
I think I know what you're saying, yes, but there's one more thing we have to do in the cash flow statement now. You're talking balance sheet.
Net income?
Net income always starts the cash flow statement. 1,200. Then
Depreciation.
full add back depreciation. Yeah? $2,000 add back. Gross amount, not the net amount. So the cash impact is 800. The tax savings. Makes sense. We're saving taxes. So when you look at the balance sheet, we have the slight cash impact on the tax savings. Okay. We have depreciation. What does depreciation do? Cash 8,000. And what else? 800. I'm sorry, 800. Yep. And then what? PP&E reduces by 2,000. And what else? Net income impacts what? And what's that line item? Mm-hmm. 10 earnings is 1,200. Okay. So you add that to the final balance sheet. We've generated a little bit of cash. Our PP&E goes down from 20 to 18, and our retained earnings is negative 1,200. So a little bit of a difference than what we had done, showed on the board, where we just had PP&E down by 2 and retained earnings down by 2. It's a little bit, retained earnings is a little bit less of a hit because of the tax savings.
This would apply only if you actually have something to tax on. So if you don't have any
Yeah.
revenue,
Yeah, then it would become a carry forward, an operating loss carry forward, but you'd still account for it that way. If you had zero revenue and you had a bunch of expenses, then you'd still record taxes that way, but that would go into an asset, a deferred tax asset. Yeah. Okay. And by year 10, PP&E will be 0. Right? This is slowly wear down, wear down, wear down.
That's why I want to ask the question. What happens if your equipment has a salvage value, you cannot make zero at that point?
Yeah, okay. So everybody okay with this? Okay, so yeah, so some, and that's what this example is here. Some assets have a scrap value or residual value or salvage value, meaning at the end of its life it's not worth 0, it's worth, maybe you can sell it for the scrap metal or something like that. If it has a salvage value, then you just subtract that salvage value from the gross value of the asset before depreciating. In other words, here's the example right now. So we have this truck of $20,000 before we just divide it by 10 years. But if it has a $5,000, for example, salvage value, then you wouldn't depreciate 20 over 10 years. You'd only depreciate the difference, the 15,000 over 10 years, the 15,000. So that 15,000 will whittle away to 0, but you're left with that 5,000. You're just not touching that 5,000. So the general rule to follow for all straight line depreciation is it's your purchase value or the value of the asset minus the residual value divided by useful life. And if that residual value happens to be 0, just plug 0 into that equation. That works for every straight line situation. Okay? That's a good point. Now, in addition to straight line depreciation, there's also accelerated depreciation. What's the difference? What's accelerated depreciation?
So we'll get a lower net income.
Yeah, so accelerated depreciation is there is more depreciation early on, meaning less depreciation. The depreciation is lower as time goes on. So in other words, you're depreciating the same asset, all encompassing eventually $20,000, but you're depreciating more earlier and less later. You're pushing that depreciation up. Why would you want to do that? Why would anyone want to do that?
No tax benefits early on.
More tax benefits early on? Why else would you want to do that? Yeah, well, there's ways to manipulate the revenue that way for deferred taxes. We'll talk about that. Anyone else?
Keep cash. Because you don't.
Yeah, I mean, that's kind of what we all said. Yep.
We don't know how long the assets usually last, so you don't want to miss out on that. Tax benefit.
Yeah. I mean, in other words, some operators actually believe that their assets do depreciate faster. So you want to, automobiles is a good example of that. They actually may depreciate more early on, so you'd want to push that out early on. Yes.
But,
Automobiles, cars.
I mean, most of the equipments, they don't have the let's say, 5-year or whatever the accounting. Sometimes they don't they declare that's the life of this vehicle is, let's say, 5 years, the other one is 8 years. There is no conduct limit for the assets or equipment.
Say that again? I don't know if I understood your question.
Let's say if you have one equipment and you can accelerate it for depreciation time, but isn't it the kind of the regulation that you have to follow that? Let's say your track is you cannot make 5 years if it's 10 years.
Mm-hmm.
And that's the
Yeah. So you're not doing that. You're not changing the useful life. There's a different way to accelerate the depreciation. So how do we accelerate the depreciation? You're not sure, because if you shorten it, then it's just greater all along. You can't do that. You're right. How do we accelerate depreciation? What are some ways to do it? There are some other ways to do it that's allowable under GAAP. You're not changing the useful life. You're using different methods. Does anybody know? Chris knows? Yeah, you were saying?
Some machines are simply more, like they have a fixed number of production.
Yes, units of production. There's several methods. One is called units of production, where some machines have a fixed amount of production and they produce more earlier and less later as they degrade, and you can get a percentage of depreciation based on that, units of production. There's one called sum of the year's digits. There's one called the declining balance method. The declining balance method is probably more popular when you use IFRS. The declining balance, double declining balance, we'll do an example of that, where you basically get a percentage, and the percentage is the reciprocal of the useful life. So if the company has, the double declining balance is, if the company has a 10-year useful life, then you get the reciprocal of the useful life, which is just 1 divided by 10, which is 10%, and you double it, 20%. So you apply 20% to the remaining balance of the asset each year. So we'll do an example of that. The U.S. method, the only way you can accelerate depreciation in the U.S. is by using this Maker's Modified Accelerated Cost Recovery System, which is a series of percentages that you would have to look up. They're given on irs.gov, and those are percentages that start off large and they slowly decline. So you would apply those percentages. Okay, so it's the Modified Accelerated Cost Recovery System. So I'm just talking about what those methods are now. We'll spend time practicing those methods, but just start to know them. Units of production, some of the year's digits, declining balance, double declining balance, Modified Accelerated Cost Recovery System. Those are all the different types of methods. Okay. What they all do, though, is in the end, they all end up with a higher percentage earlier and a lower percentage later. That's the idea. So it gives you greater depreciation earlier and then less depreciation as you go on. Okay, so we'll talk about how that works. I just wanted to mention the reasons for accelerating, which is more tax benefits. Okay. Any questions? Okay. So what I want to do is I want to apply straight line depreciation to Walmart. Okay, so let's look at the model. And as you know, we had gone as far as we could with the cash flow statement. We need to start building out the supporting schedule. So today we'll focus on depreciation, maybe start talking about working capital. Monday we're going to do working capital, finalize the supporting schedules, tie everything to the cash flow, and then Tuesday we'll start talking about what the balance sheet's about, how to build the balance sheet, how to balance the balance sheet. Maybe Wednesday we'll spend practicing that, and then Thursday we'll get into the debt schedule. So we'll be, by the end of next week, pretty far along with the modeling. Okay, it goes quick. So you might notice there is a tab that is separated out for the depreciation schedule, and I want to focus on the top portion. And the way this schedule is laid out is you first have two lines that represent what we're going to be depreciating, the PP&E and Capex. So don't forget the complexity of having to model this is you're depreciating more than the PP&E, you're depreciating the capital expenditures. The capital expenditures is representative of the property that will be built in the future. And if it will be constructed in the future, once construction is complete, you'd want to model out depreciation on that as it's complete, as it's completing. So that's where the difficulty in this will lay out. So we'll do this. So the first two lines lay out what we will be depreciating, PP&E and Capex. Underneath, we are going to model out the depreciation in two ways, on a straight line basis, then on an accelerated basis using the modified accelerated cost recovery system. And then we'll interpret from there. We'll talk about deferred taxes, other methods, things like that. Okay? So the first thing we need to do is we need to identify the company's PP&E and the company's Capex. We have the Capex because we have projected it, but the PP&E we don't have. So, what I'd recommend doing at this point is looking up the PP&E. And so if we go to the annual report, oops, what's happening here? Actually, this is helpful. I just don't know how to go back to that now. The balance sheet lists the PP&E. So I want to identify where the property is. Now, there's going to be a discussion on the depreciation projections, which is going to add a bit of complexity. I'm going to explain why it's easier in the beginning to calculate off of a net PP&E. Okay, so my point is, and just go with me on this, when starting the depreciation schedule, and then we'll talk about breaking it out, you just want to get the net total PP&E. So if you look at Walmart, they have PP&E, they have property, plant, equipment, the original purchase price, then they have less accumulated depreciation. My point is we want the net value after all the depreciation up to this point, because the idea is we want the last reported value of PP&E because we're going to calculate from here on out our depreciation. Okay? That's one thing. The second thing is notice they've broken up PP&E into two places, PP&E net and the PP&E that's held under a capital lease. I will combine those. All different tiers of property, and it's unusual for property to be separated out in that way. Usually you have one net property value. All the tiers of property I would combine into one. If you need to go in and delineate further, I would break it out later, but you'll see when I talk about this that it's probably over-engineering to do that at this point. Okay, so the PP&E value is going to be the 109,603 plus the 2721. Now, to avoid redundancies, that number is going to go here. Okay, but this is ultimately a balance sheet number. We haven't done the balance sheet yet. We have not hard-coded the balance sheet yet. So what I'm going to do is, just thinking ahead, I don't want to hard-code here and then have to hard-code it in the balance sheet again. So what I'm going to do is I'm going to hard-code it in the balance sheet and then pull it into the depreciation schedule. Okay? If you did it the other way, it's fine, but I just want to list the net PP&E here. I think it's just easier, and then have it link into the depreciation schedule. Otherwise, I'm going to be linking it into the depreciation schedule, hard-coding it in the depreciation schedule, and then later I'm going to end up hard-coding it again in the balance sheet, and that's just, I do not like, I like to avoid as much as I can hard-coding the same exact number in two places. That's easy cause of error and mistakes. Okay, so knowing it's going to ultimately be here, I'm gonna hard code in 109,603 plus 2721 or 112324.
That's how much? What?
112,324. And link this will link into the depreciation schedule. I think this is erase this. I was referring to this is linked into the income statement. This is just delete that. I don't know how that got there. It's going to pull into okay, I'm going to pull it into 2013. Okay, balance sheet in from 2013. Okay. The idea here is this should be blue. We'll talk about timing in a second. The number that I've given you was end of year 2012 balance sheet information. Okay. We need that number to project 2013 depreciation. So in parentheses, timing is going to be something we're going to have to consider here. In parentheses, I show beginning of year, meaning the end of year 2012 will be our beginning of year balance in 2013, right? Whatever is reported December 31st is going to be the same thing almost January 1st of the next year. We're going to use that number to project the depreciation in 2013. Okay? We also want to pull in Capex. Okay, so Capex we're going to pull in from the cash flow statement. If you remember in the cash flow statement, it's shown as a negative, so I'm going to pull it in minus to make it positive. I want it to be positive. Minus cash flow statement, 14213, copy to the right. Okay? Now, we're going to use the straight line depreciation method to depreciate this. Okay? And we need to figure out what the useful life is. Okay? You guys here? Yeah, okay. So I want to figure out useful life. So I'm going to go to the annual report and I'm going to do word search on depreciation, useful life. Let's see if they talk about it. Oh, one quick thing. I didn't just assume the company depreciated on a straight line basis. I had to look it up and I mean, chances are that's what they're doing, but they talk about it. And I'll show you where. So you do have to do a little bit of research on that. Okay. We talk about it in a note. I must have just missed it. So I remember.
If you look it up by useful life or useful. Yeah.
Let's do that. Good suggestion. Okay, useful. Here. Good. Thank you. I was afraid useful would be too common a word. Okay. Now, here they talk about depreciating the assets on a straight line basis. Okay? So there's confirmation there. Now, first problem. One, they break out the property into 3, 4, 5 different segments. Problem number one. Two, within each segment, they give you a range of anywhere from 3 to 40 years. A very wide range. Not helpful. And you're going to see this in most companies. You're going to see a breakout like this. You're going to see a very wide range, and you're going to ask yourself, well, how do I figure out what this is? Some people try to take a weighted average. Some people try to, and there's a lot of ways to kind of think about that. A lot of times, no matter how much you break it down and how much you try to engineer that, you will see an unusual trend in the depreciation the way you project it. Okay? There's reasons for that, and I want to talk about that. Before I talk about that, let's get the mechanics in. I'm just going to take a midpoint for now. We're going to change it, but just to get the modeling in, and then we're going to go back and analyze this problem, I want to just take a midpoint here, which is, let's say, 20 years. And I'm going to apply 20 years to all our property. But then I want to go back and say, okay, so how do we think about this and adjust this? Okay, so let me just go in, and I'm going to put 20 years for PP&E. Okay, and I'm going to depreciate PP&E. So what we're going to do is we're going to look at the PP&E depreciation different than the Capex depreciation. So I have two rows here to depict two streams of useful life depreciation, PP&E and the Capex. So we're going to assume that the PP&E is on a 20-year depreciation, and we'll adjust that. And so down here in the depreciation section, this is where we're going to calculate the depreciation for each piece of property. Okay, so for PP&E, it's going to be the PP&E divided by the useful life, just like what we did with the truck on the board. In other words, for a property of $120 million divided by 20, or it's $120 billion, there's $5 billion in annual depreciation. And because we're using the straight line, what's the number going to be next year? Same. So we can't copy to the right, of course, because if you copy to the right, you're going to have to divide by 0, because the references are going to shift, as always when we copy things to the right. So we want to anchor the references that we talked about yesterday. You can anchor the references in two ways. One is by putting dollar signs before each cell, $G, $G, or you can just hit F4. F4 adds those dollar signs in there for you. When you do that, you can copy to the right, and it will, carry things forward for you. Right? So now when I go to the right, it didn't shift the references. It locked, anchored the references. Okay, so that's the depreciation on the PP&E, right? Each year, 2013, 14, 15, 16, 17, 5616.2. Okay? We want to do the same thing for each Capex each year, because the Capex represents what will be built in that year. So just for now, to keep it simple, let's assume it's 20 Capex. And this row underneath represents the depreciation on the 2013 Capex. So let's assume it's on a straight line for 20 years for now. So we're going to take the 14,213 divided by this 20. So depreciation on the 14, 20 years. So the depreciation on this Capex property that will be built by 2013, the expense will be $700 each year.
Did you anchor both as well?
I did. Okay. And we're going to total these columns. So in other words, in year one, we have depreciation from the 112, then we have depreciation from the 14, right? In 2014, we're actually going to have 3 streams of depreciation. In 2014, we're going to have depreciation on the 112, depreciation on the 14, and then we're going to have depreciation on the 15. Right? So when we go to Capex 2014, this is asking for the depreciation on the property that will be built in 2014. So it's going to be 0 here. It's going to be 0 in 2013 because 2013 that hasn't been built yet. But we're going to start the depreciation here, 2014, 1 year out, where we're going to have the 15065.8. Oh, let me just put a 20 here. Okay, we're going to have this 15065.8 anchored divided by the 20. Okay, so the idea is as we build property, we're going to be stacking on more and more depreciation. Okay. You okay with that? Yeah?
Okay, so as you spend more, you're going to stack on more and more depreciation.
Yep. Yeah, so next year, so in 2015 now, what are we going to have? We're going to have depreciation on the 112. We're going to have depreciation on the 14th, depreciation on the 15 million, and then new depreciation on the 15969. The more we build, the more depreciation we're going to have on the last. So that's why for 2015 Capex, we're not going to have a depreciation for them in 2013. We're not going to have a depreciation for them in 2014 because that property hadn't been built yet. In 2015, though, and I'm going to assume it's 20 for now. Whoops. We're going to have the 15969.7 anchored divided by 20 anchored. Okay? And so on. Okay, so I'm going to do the rest quickly, but I'm going to give you some time to catch up. This is a waterfall schedule. It's a tiered depreciation schedule. This is how it's most commonly done. What the heck? There you go. Okay. So, just want to make sure you get 96222. Take your time to practice that. Want to make sure everyone's matching. Okay, now that we have depreciation, we can link this into our income statement and into our balance sheet. Sorry, and into our cash flow statement. Okay? So our income statement, right now we left depreciation blank. Right? Let's link it in from the depreciation schedule. Copy to the right. If you've linked it the way I did, this would automatically flow in to the cash flow statement. And it should, and it does. Okay? Now, everyone have that? Notice something. Depreciation had been steadily growing, and it dropped. Now, I know he threw a random useful life number in there, so maybe you're not surprised. But I've seen this a lot. Even when you go in and try to do weighted averages or and you do all this analysis and you're breaking it up by assets, and I always see, not always, but I often see depreciation either dropping or climbing, or unless the company has had some major divestiture or major write-down. And I mean for a company like Walmart, it's got to be like half their assets, which probably won't happen. Depreciation should be slowly climbing and rising steadily at the same rate that your Capex is steady, which is the same rate as your revenue. There should be no reason why there should be a major drop or increase in depreciation. Okay, so no matter how you dig in and overanalyze or analyze this, if I see something like this, it's wrong. So why is this happening? So I mean, first of all, it's happening because we use random 20 numbers, but there's other reasons why. So what I'm going to do here, you don't have to do this. I want to pull in the historical depreciation just so we can track just for this analysis, and I'm going to end up deleting this, so don't feel like you have to do this part. But there is a reason why, even if they had given us, so we used 20, remember, because we got all these crazy ranges, 3 to 40 years. Even if they had given us an exact useful life and an exact net PP&E, that still wouldn't give us an appropriately trending depreciation. Do you know why? Because I know that a lot of people say, well, you got to take a weighted average, and that's going to give us appropriate useful life. It still won't.
Is there another component that's missing?
There are 2 other components, yes. Why? Good thinking. Even with the useful life, you need to know 2 things, which you'll never find out.
The accumulated depreciation.
They would have that. Actually, this one has one of the 2 components. Sometimes they won't both. But there are 2 components that you need to know in order to rebuild depreciation to the exact.
Well, we want to know the true depreciation of the assets, right?
Yes. And in order to do that, what do we need to know? Market value, which you might be able to back into, but the original, in other words, you need to know the original purchase price and the scrap value, and what else? One more thing. One more thing.
The useful life prior.
What happens if you get,
Let's assume that, obviously, but let's assume that they gave us that.
what happens if you get the loan with the equipment and paying as for the loan?
That won't apply yet. Yep, loans we'll talk about in a second. Loans we'll talk about when they do the debt schedule. That won't impact depreciation. Market value, kind of purchase price, and what? Original price, scrap value, what else? Give up? Well, they gave us straight line. So yeah, there could have been write-ups or write-downs in the interim, but let's assume that's not there. Good point, though. What else? One more component. Yes?
Usually there's something buried additionally in that number.
There could be, but there's a more conceptual, kind of simpler thing that I'm getting at.
What happens if you maintain the equipment in the time period?
Maintain how?
Let's say if you have like or whatever and you had some problem and you maintain the
Additional maintenance? That would be buried in the Capex.
it's not
So, additions to the improvement, good thinking, write-ups, write-downs, maybe not where I was getting at, but could be potential issue, but I want to focus on this one more piece. Give up?
Yeah.
Yes? You're just like, let's get on with it. When the purchase happened is really important. Because the problem is this, because you can say, and this is something that a lot of people overlook, you'll never get that, because you can say, okay, well, you can say, well, all right, well, I have a $20 million, $20,000 truck, and the useful life said 10 years, right? So you look up the PP&E, and the PP&E, net PP&E says 18 million. So you think, okay, well, I take 18 million and divide by 20 years, and my depreciation is now 1,800 a year. That's wrong. It was 2,000 a year. Because you didn't get the original market purchase value, and you didn't know when it was purchased. So they reset that every year. So my point is, even if you need to know all those variables, and you need to build a depreciation schedule all the way back from the original year it was purchased to be able to tie into a depreciation that gives you the exact number. So you're not going to do that. Huh? Ask quick. Ask quick. Why is it 1,800? You understand, yeah? Okay. I didn't pressure you into forgetting the question. Okay. My point is this. No matter how you think about backing into that number, the number actually represents not what their actual useful life is, but how much life is left. And they're not going to report that. That's something that bankers are thinking about. So my point is this. We're going to back into that number. You can do all the diligence, all the research. I see people having a depreciation page with 50 line items trying to break it out, and it still never ties in. We need a number for PP&E that represents how much life is left. What do we want? We want a number that represents a trend that's identical to what we've been seeing historically. In other words, there's been about 6 to 7% growth each year and a 22% drop. So we have overestimated the useful life of our PP&E.
How did you find what percentage?
I calculated. So how do we adjust that?
Change the PPA and
Which way?
the
Down. Oh, I thought I said up. So if I drop PP&E, too much. If I raise it up by 15, okay, goes up to 819, maybe, yeah, it's okay, maybe a little bit lower. Is that what I end up with? 14, 7% growth. That's what I want. I adjusted the useful life to get to a base level of depreciation that's in line with what we've done historically. I don't care how much you've broken it out. If it doesn't show this, something's wrong. I don't care how much you've engineered it, done all your research, dug into the assets, dug into the life. If it's not showing something like this, something's wrong. Remember, depreciation is added back anyway in your unlevered free cash flow. So I want to start thinking about things that are worth spending time on and things that might be not so important. Okay, so adjusting the value of your PP&E. Useful life. It doesn't have PP&E useful life. Adjusts the net value of your depreciation. Now you want to look at the future year-over-year growth. If your year-over-year growth is too high or too low, that's your Capex depreciation. That's your Capex useful life, because it's the stacking of the Capex depreciation that's causing the future growth of depreciation. So if your future growth depreciation is too high or too low, now you know you need to adjust the Capex. So right now, 8% is a little bit too high compared to before. So I'm going to up this to 25. That's a little better. Okay? It's a little better. So I would recommend to back into the useful life that's indicative of, the idea here is that PP&E has effectively 14 years left. You can do weighted averages, you can do all this stuff. If it's not around that number, it's not going to look right. It's not going to be right. Okay? So, adjusting the value of PP&E life adjusts the base level. If your depreciation generally is way too high or way too low, start with the PP&E years. Then look at the future year-over-year growth. If the year-over-year growth is too high or too low, because sometimes you'll get, like we got before, like the level, okay, the level's okay, it's around 8 billion, but our depreciation is growing in the future a lot faster than theirs, than it has been historically, then you know that's because of the Capex. Because it's the future Capex that's causing, this is the growth here. The growth here is all Capex. Okay? Any questions? Yes?
This is only for the straight line.
This is only a straight line. Okay?
Yeah, so what happens if you have like an asset that depreciates within like 3 years and you're projecting 5, but then you have this 0 in the last couple of line items. And what happens if
Yeah, you zero it out.
let's say like they sold off some assets, all their assets at like 2015 or 2014,
Mhm.
and then they bought assets with shorter useful life, right? Then would you maybe adjust the schedule to like a weighted average or something?
Okay, there's a lot of questions there. I forgot the first one. The first one was,
The first one was, what is it like, the asset reaches its useful life?
okay, in a company like this, an asset should never reach its useful life. Because if it does, then you should have planned your Capex schedule to replenish it. That's one thing. So you want to make sure there's a balance there. That's question one. What was the next one?
The second one is like, what happens if they sold some, but most of their PP in like 3 years?
Okay, then that's an M&A thing. When you divest PP&E, you rebuild your depreciation schedule. We'll talk about that in a minute. And the third question?
Yeah, and then they report something.
Okay, yeah, that would kind of fall into play with that. Okay. Any questions? All right. Let's look at accelerated depreciation. So we talked about the idea of accelerating depreciation and how it's basically giving you, instead of flat each year depreciation, it's giving you more depreciation early on and less later. And the benefits of that, there's a couple benefits. One is getting more cash benefits earlier. There are several methods. The U.S. method is the modified accelerated cost recovery system. That's the only way to accelerate depreciation in the States right now. And so what we do is, it's a series of percentages that start off high and decline. They all add up to 100%. And to get those percentages, you would look them up. So you can go to irs.gov. They move around the page a little bit, so I'm just going to Google Makers Depreciation Table or Makers Table, and hopefully they'll come up with the, oh, that's new. They're listed out here. Yeah, I don't remember seeing it ever in Wikipedia, but here it is in irs.gov, and they'll give you a series of tables. Okay, and you would use these percentages. Okay, depending upon what the useful life of your property is. So if you have a property that has a 10-year useful life, then you'd use these percentages for makers. If it has a 15-year useful life, then you use these percentages for makers. If your useful life is in between, then you just got to kind of pick one. And 20-year, okay? There is also different conventions that you should know about. There's half-year convention, mid-quarter convention, mid-quarter convention, second quarter, mid-quarter convention, third quarter. So what do these mean? Well, they deal with the timing of when the property starts depreciating. So we didn't really consider that. And you really usually don't as an analyst. It's a little bit too nuanced. But if you have Capex, there are theories when that Capex property starts depreciating. Does it depreciate from the day the property has been built? Does it depreciate a quarter later, 2 quarters later, half a year later? That's what this is. Half-year convention means the property doesn't start depreciating until half a year later. Mid-quarter, it doesn't start depreciating until halfway into the first quarter. This is halfway into the second quarter, halfway into the third quarter. What difference does it make? This is the way I can explain it. In a 3-year property on a straight line basis, how much would it be depreciated each year?
Years?
Yeah,
33.
33.3%. Right. Notice, so that means to have the depreciation accelerate, the depreciation percentage needs to be greater than 33%. Right. In this mid-year convention, the first year depreciation is 33%. It's equal to the straight line. So that's not accelerating, is it? Okay. It's 33% because they cut it in half. They basically, it should be 66.67%, but they assumed, well, half-year convention, it's not going to start until midway through the first year, so they cut it in half in the first year. That's the idea of the half-year convention.
But when we consider that the 66%,
Say again?
when we calculate our depreciation for 1 year, we calculate just 66% on exaggeration.
No, you use this. So let me finish. So in the other table, where the depreciation starts in the first quarter, will the depreciation be higher or lower? This is 6 months out. If it's 3 months out, higher, because they're assuming only first month and a half, maybe. So if you go to the first quarter convention, here's a percentage that's closer to the 66.7. They've kind of haircut that by half of the first quarter, a month and a half, 58.7. In the second quarter, it'll go down a little bit. In the third quarter, it only impacts the first year. Second year, third year, fourth year is the same, 27, 12, 1. Well, you know what? Actually, you're right. They take a percentage and push it all out, so it all equals to 100%. So the first year, in year 3, is a little bit lower. In the third quarter, it's the lowest. My point is this. The differences in these tables are the timing of when the first year property comes into play, and then they take the remaining and just divide it by, and smooth it over and divide it by a percentage. For that reason, we typically always use the mid-quarter, first quarter convention because it gives you the highest percentage in the first year. Okay? Everybody okay with that? Repeat what?
What did you say about which table we use?
Okay, so
Or the other one?
we use the first quarter. We use the first quarter because it gives the least adjustment to the percentages. Why? Well, the first table, the half-year convention, assumes the property will not come in, the depreciation will not begin until halfway through. So even though the accelerated depreciation should really be like 66.6%, they divided it by 2 because they said, okay, well, it's 66.6% for the full year, but we're going to assume it's not going to start depreciating for half the year, so we're going to cut that in half. That's the half-year convention. The next table, the mid-year convention, says, okay, well, it'll start depreciating in the first quarter. So there's going to be that's the table that has the most depreciation in the first year. That's why the first percentage is closest to 66.7%. So we always use that table, the place in service first quarter. Okay? Questions on that? So what we would do, if a company has a useful life of, let's say, 15, we would go to typically the first quarter convention table, and we would use these percentages and apply the value of the PP&E to these percentages. I'll show you how. So in this case now, we had adjusted our PP&E to be 14. We're going to use the closest best number, which is the 15 one. There is no PP&E table for 14 years. So we're going to use the 15 one. And if you notice in the accelerated depreciation section, there are 2 subsections. One where we're going to list our percentages, and 2 where we're going to apply those percentages to a value of depreciation. Okay? So I'm going to lay out these percentages in the existing PP&E section. So 15 year, Mid-quarter convention, 8.75%. Okay. 9.13%. 8.21. 7.39. 6.65. Okay, I'm going to use these percentages, and I'm going to apply these percentages to our value of our property to get accelerated depreciation. Okay?
Can you have the name of it? In 2015, 8 or 9?
Mm-hmm. 875-913-821.
It's on the cell phone.
Yep. I'll zoom in.
You go right there, okay?
To this table? Yeah.
That's from,
Where's it from? IRS.gov.
no, the top line.
Oh, yeah, place service in first quarter? Mm-hmm.
It's like you pull-
Oh, this 15-year. Yep. Okay, got those numbers in, and then we apply them. We multiply the percentage by the value of PP&E. So in other words, in the first year, under the existing PP&E line, we're going to take 8.75% times the value of PP&E, the 112. That's it. 8.75 of that. In the next year, okay, it's 9.13 times that. And so on. Now notice I have zeros here. Okay, I have a 0 here because it's 9.13 times it's shifted that reference. Right? So we want to anchor just part of the formula. We want the percentages to shift, but we don't want the reference to PP&E to shift. So we want to anchor just the reference to the PP&E. Okay? So I'm going to anchor the reference to G6. Copy to the right. That's what I want. Okay? And notice the way the accelerated depreciation works. It's higher in 2013, 14, 15, slowly going down by 2016, 17. It's no longer higher anymore, right? It's higher than the straight line, and then over time it's going to be smaller than the straight line. In the end, you're depreciating the same amount, but just shifting more of the expense earlier, giving you greater expense earlier, giving you greater tax deductions earlier. That's the benefit. Okay? You guys have that. We're now going to do it for the Capex. Okay? You guys got it? Need more time? So for Capex, let's look up the percentages. We had a 25-year useful life. They're maxed out at 20 years, so we're going to have to use the 20-year numbers. 6.563. Okay, and I'm just going to expand this to 3 decimals so you don't... Sorry, you can see 6.563. Okay, 7, 6482, 5996. Oops. 5546. Okay. Okay, so for the Capex, we got to do 6.563 times that Capex. 7 times that Capex. 6482 times that Capex. This is 2013 Capex. So we're going to link to 6.563 times the 14213 that you anchor, so when we shift to the right, this stays fixed, but the percentages change. Okay? That's what you should be getting. Okay? Good. For the next year CapEx, we're starting in 2014, because this is CapEx that won't be built until 2014. We're going to use the same percentages because it's the same 25-year useful life. So I'm going to copy these 4 percentages over. Okay? Where that 2014 property is going to start depreciating at 6563, next year at 7. Don't make the mistake of taking that property and multiplying it by 7, because it's the next year out. Right? Every brand new property starts accelerated from scratch. If you do it the other way, you're not accelerating anymore. Okay? So this property, you can take the 6.563 times the 150658, copy to the right. Okay? You can see the pattern. Okay? Getting that? Okay. And the next year. Okay? And I'm going to do it for the next year and the next year. So let's see the pattern in percentages. Keeps shifting over. Okay? And so for the CapEx in that year, 6563 times the CapEx in 2015, anchor that. And in the next year, it's the 6563 times the CapEx in 2016. And then 2017, it's the CapEx in 2017. So I want you to get familiar with that pattern. And you can do a big alt equals to add everything up. And why don't you take a few minutes to see if you can match these numbers.
You copy that?
I did Control C, Control V.
Oh, got it.
All right. I want to talk about the purpose of accelerating depreciation. There's a couple reasons why you'd want to accelerate depreciation, right? One is, because we spoke before, naturally there is a benefit of, or some people actually think their property depreciates faster, like automobiles. It just matches with the way that their property is degrading. Anyway, second is the ability to free up taxes, to free up cash in the short term, right? Deferred taxes. So I want to talk a little about deferred tax liability and deferred tax assets. So deferring taxes or deferred taxes can create a liability or an asset from 2 different perspectives. And so let's start with the liability. A deferred tax liability is generally created from timing differences, accounting differences between tax reporting and like U.S. GAAP reporting or IFRS reporting. Right? In other words, there are rules that you can follow that will change between the 2 sets of reporting statements. So, you know, in other words, you can account for certain things on your tax statements one way and then account for them in GAAP another way. And those differences could create tax implications. Okay? There are different areas within, let's say, your income statement where you can do this. One area is your method of depreciation. In other words, you can change your method of depreciation between your tax and your GAAP statements and take advantage of those differences. That will create a deferred tax liability. When I say deferred tax liability, I mean you maybe are owed some taxes, but you don't have to pay them all right away. Okay? Let me explain better with this slide. The slide is hard to read, but you have it on slide 17. And so, I could zoom in, but it's not going to have too much. Let's say that we have two sets of financial statements. Financial statements set for GAAP purposes and financial statements for tax purposes. Okay? Now, in U.S. GAAP, you have a choice for whether you want to depreciate on a straight line basis or on an accelerated basis. If you depreciate your assets on a straight line basis for GAAP, you can take advantage of accelerating for tax purposes on your tax reports to create a deferred tax liability. So let me show you what that means. So let's assume that each of these financial statements, you have revenue, you have certain costs, everything's identical, same EBITDA. The left column shows the income for GAAP purposes. The right column shows income for tax purposes. Okay? On the left side, we have a straight line depreciation. This is $1,500. This is the same as this truck example that we spoke about, whereas the truck, you have the truck of $20,000. We talked about this in the morning. And if there is a residual value of $5,000, 20 minus 5 means 15. Out of 10 years for life, there's $1,500 in depreciation a year. That's straight line depreciation. Straight line depreciation. This gives you EBIT of $3,500, taxes of $1,400, net income. Okay? You have the ability to accelerate your depreciation for tax purposes. What benefit would that bring? Well, if you accelerate your depreciation, you'd have lower net income, but you'd have lower taxes. So on the right side, they've accelerated the depreciation. So their depreciation expense went up from $1,500 to $3,750, which means their pre-tax income was lower, but 40% of that shows lower taxes, $500. So for the GAAP report, they can show a lower expense, higher net income, maybe higher, more profitable EPS, which is what they want. But for the tax report, you show a higher expense, lower net income, but that's not public information. Nobody sees, nobody cares. You're paying lower taxes. So what you have is, you have an income tax expense of $1,400, of which only $500 you have to pay in the short term. You've created a deferred tax liability. Okay? Do you see what's going on? Now, yes?
You have one income statement for the GAAP and one for tax.
Mm-hmm.
So GAAP would be for the
That's the public. That's the annual reporting.
that's for the annual report.
Mm-hmm.
And the one for tax can it's not the same.
Mm-hmm. That's right. Mm-hmm.
But don't they have to declare the one for tax also in the like so that shareholders would know as well?
They might have a note that they accelerate depreciation for tax purposes. They'll have a note about that. Yeah, but they won't show that tax report. It's not public information. And for that reason, that's why we don't model two income statements. We don't have a model for a GAAP income statement and a tax income statement. We don't have that information available. So what we do, and that's what this box shows us, what we do though, is we will know if they do accelerate the depreciation for tax purposes, they'll note it. And this table shows how we can back into the tax savings by simply subtracting. If we model out depreciation two different ways, straight line and then accelerated, if you subtract the two and multiply by the tax rate, this gives you the value of the taxes saved. Right? So the reason why this is laid out the way it is because I want to make sure that you know why in modeling. What we do is we model out straight line depreciation, we model out accelerated, then we subtract the two, multiply by the tax rate, and that's a way to back into what the actual deferred taxes are. It's important because analysts do it all the time, but it's a common question asked and they can't answer why that actually gives you a deferred tax liability. So this is a nice way to lay that out. Okay.
So that deferred tax liability will be recorded in the GAAP
The liability goes on the balance sheet.
under the balance sheet.
Mm-hmm.
So in a way we can work out.
And cash flow statement.
So I guess in that way we kind of can work out what we have declared to tax for depreciation at the budget.
You mean by backing into the historicals?
Yeah.
Mm,
But yeah, it's too much.
No, not that it's too much work. I don't think that would get you there. How would you do it?
Well,
It wouldn't help you with projecting.
because I mean if you can get the deferred tax
Mm-hmm.
assets
Mm-hmm.
by taking the difference between the GAAP income and the GAAP depreciation and the GAAP and the tax depreciation.
But you won't have tax depreciation. You're going to be calculating that.
Alright, okay.
Yeah.
Alright.
You can't back into it. Mm-hmm.
If you pay more taxes upfront on an accelerated basis, that means that you're paying for the rates, right? Obviously, but then would you create a deferred tax asset or deferred tax liability? Deferred tax asset, right?
If it's the other way around,
No. If you're paying more tax upfront, which lowers your net income,
that's
that'll be a DTA or a deferred tax asset. Right?
that's an asset.
That's an asset, right?
Mm-hmm.
So backtrack. So we need two ingredients to get the deferred tax asset, right? So there's the GAAP depreciation and then there's tax depreciation and then you get this. So if you have this, the deferred tax, you can backtrack. Because it's out of three, one is you have the two of them, you can work out the other one.
You have the deferred taxes.
Yeah.
And you have the depreciation.
Yeah. So you can work out the tax depreciation.
Historically. But how are you going to use that to project? I guess that's because if what you're saying is, okay, so you have the deferred taxes from the cash flow statement, you have the straight line depreciation cash flow statement, and then you just add it, and that gives you the accelerated depreciation. But how does that help you? Because you want to project it.
Well, then you'll be able to see, if you know the tax depreciation, you can use that as a check on our tax depreciation projections going forward, right?
Yeah, sure. Why not? Yeah, if you want to just kind of use it as a check.
Yes.
But they'll report that. You can just look that up. Yeah. If you're talking about the same thing. Chris.
The companies always have like do a straight line and then do the.
No. Now some companies will just do accelerated all the way through. They don't care. Some companies won't accelerate, And so that's why for this reason, and actually Walmart doesn't do it, but I just put it into the model because it's something that analysts need to know how to do because it's done quite commonly. But actually a lot of companies don't do it, but you need to know how to do it because a lot of questions come up with it. So that's why we've done it in this model, even though Walmart doesn't actually do it.
So Walmart doesn't have deferred tax.
They do, but they have deferred taxes for different reasons. Yeah.
And then this kind of the method isn't for the high-tech company because their machine or whatever computer is getting all the software.
Companies that are high in assets, yeah, would be more prone to doing it. And there are other things that you can adjust. How cost of goods sold is recorded between tax and GAAP. First in, first out, last in, first out. There's a lot. There's other things you can do, other accounting differences that you can take advantage of to create deferred tax assets or deferred tax liabilities.
So the reason why they want to declare something different from GAAP is it so that the net income looks nicer, smoother, or like why?
The reason why they want to what?
To show something different from GAAP rather than tax.
Well, the reason why they want to accelerate, what were you saying, Chris?
Like to pay less.
To pay less. The reason why they want to accelerate is to reduce the tax. Yeah.
Tax. Yeah, so why not just like do what's declared for tax also in GAAP? Just to keep things simple. I mean, accountants have many other things to do.
I mean,
And have two different depreciation schedules. And so I'm just trying to
accountants have better things to do could be answered in a million different ways. I don't know how to answer that one. That's true. I would think accountants have better things to do than to do accounting. Well, in this example, sticking with the line of the trucking company, right? He set up his company. He had these unexpected repairs to his truck, right? Remember that whole situation? He had this cash flow issue, right? Remember the situation that we were dealing with? It's a good question. He has this cash flow issue. Now what happens? He can't change his accounting method. You can't just go ahead and change your accounting rules year to year. You're flagging yourself for auditing, right? You're flagging yourself for SEC investigation. You can't just this year accelerate. So he says, okay, well, for tax purposes, I'm going to make a little adjustment, right? So he says, I found that I can refile and re-amend my statements for tax purposes. It's a bit easier. I don't have to go through SEC regulation, and I'm going to accelerate. So he accelerates his depreciation, and now he has his $900, right? So there's a lot of reasons why. If you maybe had the foresight in the beginning, saying, okay, I'm going to just accelerate all the way through, maybe. Some companies don't want to do that because they don't want to show a low EPS. You know, there's a few reasons why you wouldn't want to do that. A lower EPS might affect my stock price, might impact my ability to raise more funds. You know, might impact my value overall, which will hurt my ability to get credit and to get funding. There's a lot of reasons why you'd want to kind of keep that difference going. Mm-hmm.
Basically, so that maybe they want to make the income higher, so that they have higher net income, and also maybe just to be consistent with previous years.
Yeah, so maybe because I want to maintain higher income, and two, because it's very difficult to change your GAAP accounting methods.
So the GAAP accounting method does not necessarily require this straight line method, right? And you can use the tax depreciation method.
You can use accelerated depreciation method.
Yeah.
Yep, you can.
So it's more of it. I mean.
It's the what? Well, you can't change your method. You can't switch. You can't switch back and forth and say, oh, this year it's better to show earnings, so let me use a straight line. Next year I'm going to switch to accelerated. You can't do that. You set up the company, right? You have all these bylaws like we talked about in the first day of the program, and you say, I'm going to record revenue this way. I'm going to depreciate my assets this way. This is my accounting philosophy, and you really can't go back on that. You could. It's very difficult to do that, and if you do, if you really want to do it, you have to get audited, and you have to go through this whole costly investigation. So, yeah. Okay, so that's why the way we get deferred taxes is by taking accelerated depreciation minus straight line depreciation and multiplying by the tax rate in this example. So let's do that. Let's go down, and we now have our accelerated depreciation, we have our straight line. So we're going to subtract the two. We're going to take the accelerated minus the straight line. Okay, that's the difference. Okay. Multiplying by the tax rate gives us the taxes deferred. Cash saved. We're not deferring indefinitely. We have to pay it back, but we're just kind of, it's a timing thing. So it's very important that we pull in the tax rate in the actual year that we're talking about. So I'm going to pull the 2013 taxes in from 2013. Copy to the right. And our deferred taxes is the product. Okay? Mm-hmm.
One more cell.
Mm-hmm. Yeah, you have different G19.
Yeah.
What is it? You have a 14 and 25.
Oh, okay. All right.
Okay. Yeah. This can be linked. Where does this go? Cash flow. This deferred tax line. Into the cash flow. Copy to the right. Okay. Any questions? Okay.